Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we look at the line that quietly funds your business every day, trade payables. You will learn what they are, when to record them, simple journal entries, days payable outstanding and aging, foreign currency impacts and common mistakes with fixes. As always, we will use our Apple shop and a few clean journal entries. Trade payables belong to the other part of the balance sheet, liabilities. Yes, now we are moving to the other side, but it's not dark. What is trade payables? Trade payables are amounts you owe suppliers for goods or services you already received. Payables are a free, short-term source of funding. Stretch them too far and supplier relationships suffer. Pay too fast and you drain cash. Your suppliers offer you a credit period. It can be 10 days or 30 days or 60 or even longer. This is your liability, a claim of your supplier towards you. They sit in current liabilities because you expect to pay them within a year. You can find the basics about payables in our earlier videos, the link is in the upper right corner. You recognize the payable when you receive the goods or services and the supplier has a present claim under the contract. The invoice might arrive later. In this case, use a goods received not invoiced step if needed. So you recognize a payable when control of the goods or services passes to you. Now let's get back to our Apple shop. For a simple purchase on credit of jars for $1,000, when jars are delivered but invoice arrives next week, the journal entries will be: debit inventory $1,000, credit goods received not invoiced $1,000, a temporary entry. When the invoice arrives, the journal entry would be: debit goods received not invoiced $1,000, credit accounts payable $1,000. With direct invoice received, it would be: debit inventory $1,000, credit accounts payable $1,000. And now let's complicate it a bit. As with sales, the majority of purchases within the same country are done with value-added tax, or VAT, similar to sales tax in the US. And here starts the complication. The purchase that you record in inventory is always without VAT. Costs and expenses in the income statement also, all P&L is always without VAT. VAT runs through balance sheet and cash flow only. So, how do we reflect that in accounting? If VAT is 20%, your total purchase price will then be $1,200. The journal entry for the purchase with VAT would be: debit inventory $1,000, debit VAT receivable $200, credit accounts payable $1,200. The payable is the full amount, as you do expect to pay $1,200 to your supplier. But then, you have $1,000 in net cost of inventory and $200 you claim from the government. So, you record a receivable for that. 2 debit entries which add up to $1,200. Normally, you would also have VAT payable on sales. For example, if you sold for $2,000, your VAT payable would be $400. In this case, you use your $200 VAT receivable on purchases to offset against $400 you owe, and then you pay only a net amount, $200, to the government. And in a T-accounts world, it will look like this. Before we move on, if you find our lessons useful, please take a moment to hit the like button, subscribe to our channel or leave a comment. And thank you for being with the channel, this is very important for me. When you pay the supplier, you reduce the payable. Let's imagine we settle the full amount, and the journal entry will be: debit accounts payable $1,000, credit cash $1,000. And again, briefly, T accounts. But sometimes, the suppliers don't want to wait and would like to get the cash earlier. How do they motivate you to do so? They offer you an early payment discount. They email you and tell you that if you pay within 10 days, they will give you a 5% discount. And you think, why not? And pay earlier. The discount ultimately reduces your inventory and costs. In the case where we still have inventory on the balance sheet and have not sold our jam in jars, the journal entries would be: debit accounts payable $1,000, as we still need to remove the full balance we are settling. Credit cash $950, we actually pay 5% less. Credit inventory $50, we record the discount directly against inventory, as we have not sold jars yet, but they already cost us less. When we finally sell the jam, we will have lower cost for this $50 in the P&L. If we had already sold our jam in jars and recorded the costs, we would post the following journal entries. First, as a reminder, when selling the jars, we would have removed inventory and recognized cost. Debit cost of goods sold 1000, credit inventory 1000. Then, when paying the supplier early and receiving the discount, we would record the discount as our income, reduction in costs, and the journal entries would be: debit accounts payable 1000, credit cash 950, we pay less, credit purchase discounts 50. This is an income in our P&L, our benefit, to reduce the cost of sales we recorded earlier. Accounts payable rely on a three-way match: purchase order, receipt of goods or services, supplier invoice. Post the payables only when they agree with what you actually expect to pay and you know you will need to pay, and have a liability already. For month-end cut-off, capture goods received before month's end, even if the invoice is missing. Use a simple goods received not yet invoiced GRNI list so liabilities do not hide off the balance sheet. And another complication: foreign currency payables. As with accounts receivable, if you get an invoice in foreign currency, you need to record the payable at the spot rate of the invoice date. Spot rates mean the rate on the same date as invoice. For example, you receive an invoice in euro for 1000 euros. On the day of the purchase, the exchange rate to US dollar is 1.15. That means $1,150. And you record the following: debit inventory 1150, credit accounts payable 1150. What happens when in the end of the year you have not paid yet, but exchange rate is now 1.20? If you paid your supplier now, you would have paid more money in US dollar to fully settle the liability. We need to reflect that in our books. The payable will now be 1200, an increase of 50. This increase is a forex loss. We need to pay more, we lose money. Of course, it can be a gain too, if the exchange rate moves favorably for us. Now the journal entries for this. Debit forex loss 50 in the P&L. If we paid money now, we would have paid more in USD. Credit accounts payable, to increase the expected payment to our supplier. For now, our loss is unrealized, we have not paid cash yet. If tomorrow the exchange rate drops, we will need to record forex gain, also unrealized, and when we pay, it becomes realized. Note that we only change payables here, the amount we owe. The inventory balance remain unchanged and forex gains or losses are not reflected in inventory balances. This is an important point to remember. And one more point to note. Sometimes you may know that you have used a service and you will need to pay for it, but you haven't received the invoice yet and don't know the exact amount. Example: utilities you have used this month. You can estimate them, but you don't know the exact amount. In this case, you would record a so-called accrual or provision, your estimate of a liability, but not yet a trade payable. Please keep these two separate and move them to payables when invoice arrives. We will discuss this topic in the next lesson. What are the KPIs used for accounts payable? The first one is the agent schedule. It groups payables by days outstanding. It helps you spot overdue items and plan cash. Another important KPI is days payables outstanding, or DPO. Remember, we discussed DIO for inventory and DSO for receivables? Exactly the same concept. It is calculated as trade payables divided by annual costs on credit and multiplied by 365. Alternatively, you can divide payables by monthly cost and multiply by 31 days in the month. Note, better to use pure credit costs and not all costs if you also have cash costs or costs which do not run through trade payables. For example, salaries you pay will never be in trade payables, but can be a material element of your costs. They have to be disregarded. Usual approach is to use cost of goods sold as the amount of purchases may not be available. Sometimes you can also use cost of sales plus operating expenses which normally will have invoices. For example, IT costs, marketing expenses, travel costs, etc. And another note, as trade payables are with VAT and costs are without VAT, ideally you would remove VAT from payables or add back VAT to costs. Ideally. But shortcuts are acceptable, as long as it is consistent and VAT doesn't distort numbers a lot. Let's have a look at an example. Last year we bought apples and jars for $20,000. In the end of the year, we had 2000 in payables. Our DPO would be 2000 divided by 20,000 times 365 equals 37 days. So it would take us on average 37 days to pay our suppliers. This year we grew our business with costs of 30,000, payables 4,000. Our DPO are 4,000 divided by 30,000 and multiplied by 365 equals 49 days. Looks like we were able to renegotiate longer payment times with our suppliers. Well done! How are payables reflected in the cash flow? In the indirect cash flow, increase in payables is an add back to operating cash flow. You held cash longer. Decrease in payables is a use of cash. You paid faster. Always read accounts payable together with inventory and receivables for the full working capital story. What are the common mistakes? The first one. Book in payables only when the invoice appears. Fix this with a GRNI for goods received. Paying too fast but still missing early payment discounts. Set payment runs to capture discount windows. Forgetting forex remeasurement on foreign payables. Revalue at period end. Mixing accruals with accounts payable. Keep separate ledgers and clear promptly. Ignoring duplicate invoices. Use three-way match and duplicate checks by supplier, amount, date. Now let's summarize the lesson. Trade payables recognize what you owe for what you already received. They reduce cash strain when managed well and protect supplier trust when paid fairly. Record at receipt, match to the invoice, handle forex thoughtfully. Use an agent schedule and DPO to monitor the payables. Keep accruals separate. That is trade payables in plain language. In the next lesson we will cover accruals and provisions and examples of internal credit controls. If you have other questions to payables, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.